So when we think about due diligence, you know, some of the questions you hear in practice are buy a good business with sustainable earnings. Uh, so what does that mean exactly? Um, you've heard this on Search Funder as well as by folks like Walker Dybel and Cody Sanchez. But what does a business with good sustainable earnings look like? That's kind of the question. And how do we, when we're underneath the hood of a particular small business, how do we verify that that's actually happening? Those are some of the questions we need to answer. And hopefully this webinar gives you some of the tools to give yourself confidence in the ability to conduct this analysis at a higher level than just, you know, bare bones. So some of the components of financial due diligence, so we're just going to level set. When you are conducting financial diligence or even preliminary due diligence, I like to think of it as five buckets. So you have your financial statement analysis, which comprises of your income statement and your balance sheet review. Those are the two statements which house um, the presentation of the financial data. You then have components like working capital, a proof of cash, a Q of E or EBITDA analysis and review, and then a tax assessment, compliance, and risk procedure. Today, we are going to be discussing one piece of two in the financial statement analysis, the income statement section. So that's where this fits. I touch upon each of these topics in great lengths on separate webinars I've held throughout this year and last. You can find all this information by heading over to my YouTube channel. You can pause, rewind, and flip back to it. It's all free and it's there to arm business acquirers or those thinking about buying a business or selling with some information of how to conduct this analysis in micro doses. So feel free to check that out if you're interested. So, what are some of the benefits of conducting this the right way? And ultimately, it ensures you're paying a fair valuation for the business and it minimizes the risks of some potential hidden issues. So I'm always asked the question, what's a fair price for this business? Other times I'm asked, how can I limit risk when I am buying a business? Um, how can I set myself up for success? These are questions which are challenging in small business deal making, and I'll tell you why. When you're actively pursuing a small business acquisition that is unaudited in nature, um, there has not been checks and balances likely performed to verify the financial reporting of the company is fair and accurate. The reasons why is it's not required by law, um, and as long as the small business is paying taxes, um, they can keep operating as business as usual. There are certain instances where businesses are required for an annual audit, which ensures some level of accounting procedures are in place. But unless those mandates are there for the particular business, there is no legal mandate that anyone checks the books for accuracy. The only mandate is that they complete their tax filings in line with IRS standards. And if they don't, they could be subject to IRS penalties. But in terms of presenting financial statements fair and accurately, there is no requirement, largely for these privately held small businesses. There are certain nuances where banks may require it, other entities if there are regulatory environments, But in large part, there really is no requirement for accurate financial reporting. So the benefits of conducting due diligence is that you assess the fair assessment of the reporting procedures. Um, and this is done by this income statement analysis. So, you know, let's kind of just jump into three ways to think about income statement and do a deep dive on a particular business. So the income statement deep dive starts at three key margin metrics. Net profit margin, which is the overall profitability after all expenses. EBITDA margin, which is the operational performance before some of the financing decisions. And then the gross profit margin is the efficiency in revenues less direct costs. If you think about the structure of a financial statement, which we'll get to in just a second, it's in large part income statement, it's revenues or total income, uh, cost of goods sold or direct costs, gross profit, which ultimately calculates your gross margin. So this is a flash of a sample income statement, and you'll see here a couple key line items. So when I look at an income statement, it's always best practice, in my view, to start at the margin level. And the reason why we do this is because revenue metrics are vanity. There may be, you know, having flashy revenue, et cetera, is nice, but understanding like underneath the hood of how this business is performing and the health of the business, you can quickly assess this by checking out the margins of the company. So if we look here, uh, this company has a net ordinary margin of 25, 9, 12, and 29%. That was historically over the last 4 years, 21 through 24. Uh, you'll see that in the 24 column, this represents about 10 and a half months, but it gives you a good flavor of how the business is performing year over year. A couple other things to note is it's very likely things that are being tagged as operating expenses likely include some direct costs. Um, a typical business in this space is very labor intensive, so it's likely some payroll, direct labor costs are being captured in operating expenses. At a high level, this is not as impactful. Um, you should just analyze this net ordinary income margin to assess the health of the business. So when I look at something like this, the first question I ask myself is, okay, what are the benchmarks for the type of business this is? And then how is that compared to the business I'm looking at? So you can leverage resources, industry newsletters to understand what a typical business in a certain industry from a margin perspective typically operates at. Um, I frequently see, margins in the 20s. Very good businesses in other industries may operate in the 30s or 40s. But primarily, if you're a service-based business, um, home services, et cetera, margins in the 20s is typically what I see. In this case, it looks like the business was performing very healthy in 2021, 25% margins, 27% EBITDA margins is above average. I think the typical margins in this space were about 18.5 to 22.5%. So they've exceeded expectations. But then if we look at 22, something's changed. 9%, they may have had a challenging year. 23, there's been some improvement, 14%, but it's still below the expected margins based on the industry they operate in. Most importantly, when the company is being solicited for sale, something curious happens. They show a record margin number of 30%, which is it exceeds the last 4 years of profitability, which makes sense why they're actively pursuing a sale. Two things jump out when I see something like this. One, it's uh, verifying that the accuracy of these financials is correct. So really looking under the hood and understanding, is this 30% real? Has the company tried to get away with clever accounting practices to prop up this margin? Or has the business just performed exceptionally well? And have they completed some cost-cutting initiatives to prop this margin up? And is that margin of 30% sustainable going forward? Uh, when I look at something like this, uh, I begin to question how they've tracked and accounted for this year. And the reason why is if you look into the income statement, um, it produces about the same level of revenues in 23 and 24, but then all of a sudden expenses have shifted slightly. So you'll see that they had about 1.2 million of operating expenses, and it looks like they cut 200,000 in 2024 and about 80,000, 70-ish thousand of cost of goods sold year over year. So my first question would be what contributed to the material decrease in operating expenses? Was it a reduction of direct labor costs? Did you let go an employee? What's happened here? Uh, and from there, you can understand, is this earnings level sustainable? So I'll give you an example. In this case, the foreman in this company was let go, and now his duties were shifted back to the owner. The owner who's been running this business for over 30 years, to him, it seemed like a no-brainer. Uh, he knew the business inside and out. He used to perform the foreman's duties before he hired him. So running his day-to-day, when we had discussions with him, no brainer. It's going to be okay. Like I don't spend more than 5 or 6 hours on his role each week. The challenge with something like this is you stepping in as a new buyer, you likely will need a foreman in that capacity because you're going to be catching up to speed with the business. Um, and while the owner may have 5 hours of time able to achieve this role, it might take you 40. So you might actually need to hire back or hire a different foreman at a compensation level in order to keep the business running smoothly. So this margin quickly evaporates from 30 and moves back down, closer to the 20s, maybe even a little bit smaller. Uh, so this is an example of looking down the profitability of the company and seeing the business is trending well. But when you actually look under the hood on a line by line basis, you can dissect that really, this level of 30% is not sustainable. In reality, the business is more often than not going to spit out a 20% margin. And here's why. So that's an example of a vertical analysis I like to perform. Uh, let's take it one step further and look on a granular level, how I conduct a line by line income statement review for purposes of a management call. So if you're actively searching for businesses, you may receive a snapshot of a company P&L, and it might look like something like this. It'll look, um, it'll show incomes, profitabilities, but it won't show like the granular components. Um, and that's something you can request once you're under LOI and conducting due diligence. You can um, request and should request a monthly uh, Excel-based P&L to dissect the components of the analysis. So I'll show you what I mean. All right. Um, so here is an example of a water restoration company and the granular components of the income statement. And I will try to get the markings off. Bear with me 1 second. Let's see if we can. Neat. Okay. All right. Cool. So, picture this. You are under LOI for a water restoration company. You've had great discussions with the sellers. You reach out because you are looking to conduct due diligence. You might be working with a provider. This is something I work with all clients with, and you want to look under the hood of how does this business generate incomes of, a certain dollar amount. So you'll see here, if we start at a high level, um, the business is producing about 7 million of top line revenue in 2025, 5.4 million in 24, and then 3.5 million in 23. So kudos to them. This is exceptional growth of the business. It makes sense that the business is now being solicited for sale. Um, but the question is, should I be paying for a company that has reported EBITDAs of north of 2 million, or is this business really a 1 million EBITDA company? So this is the crux of what a quality of earnings and financial due diligence analysis looks to answer. So how I like to start it is a few things. I like to complete what I refer to as a vertical analysis and then a horizontal analysis. Uh, the vertical analysis, which is shown here, is what are the line items as a percentage of revenue? And based on that calculation, I like to tag um, a red, yellow, or green flag. So I conditionally format this for all you Excel gurus out there. If you're not an Excel guru, I DIY'd this and used YouTube to learn how to do all these analysis. So I encourage you to, if I can learn it, so can you. Um, so the red, yellow, and green analysis looks to show if a certain line item of the financials is a significant percentage of total revenue. That is flagged as red because you need to understand what is that? What does it relate to? What is it comprised of? And should this be meaningful when you're assessing the go forward profitability of the company you're looking to buy? So let's break this down into specifics. So if we just stay on income, you'll see in the financial statements, there's a GL account called sales. Sales represents 59% of total revenues. If everyone's still with me, you know, if you want to throw in the chat that you're still with me, if you have any questions, I can pause and answer. I would appreciate if you want to just say, still here. That'd be super helpful from my end. Um, so the sales line item is 59% of total revenue year over year. Jen, thank you for messaging. Appreciate it. The the question you have to answer is, what are the components of sales? Is this just how the company is tracking it in QuickBooks? Um, Typically, if you were to gain access to QuickBooks, you could double click on this. But a question I would like to ask is, and I will mark up the income statement, I will ask something like, what is the nature of this account? And you might ask yourself, this is broad. Why would you say it this way? It's helpful because you want to get the management group talking. You only know so much about the business. You may have learned about it a few weeks ago. The owners of some of these legacy businesses are just a wealth of knowledge. And by asking open-ended, broad questions, you can extract a lot of information. From here, I would continue moving down the line. You'll see there's another line item also called sales. And the reason why I spotted this easily is because this was flagged in my red, yellow, or green flag. I think at yellow, it starts at 25%. So it's very likely we need to understand, what is the nature of this account? Is this a different sales segment? Why is it tracked under a different GL account in QuickBooks? But we will continue to move on. Also, we'll call this column questions for management. Um, we will continue down the line and head over to expenses. So expenses, when we're thinking about income statement analysis for expenses, a few things we need to look out for. We should be flagging any expenses that look personal and owner related. Things like cars, things like life insurance. You want to find expenses that may be owner centric and not core to the business, direct business expenses. And the reason why you want to find these items is because there may not be needed in order to produce the incomes, of $7 million that this business is reporting. As a fellow small business owner, most owners will leverage, tax laws to benefit themselves with their business, such as, an employee credit card, et cetera. But the purpose of this exercise is just to understand if there's anything material that you should be asking questions about. So if we continue on and we just stay focused on the flags, because this is the first pass of the income statement, we want to look for the big ticket items. We'll see that total payroll expenses make up 43 and about 33% of the vertical analysis as a percentage of revenue. That's significant. So the questions I would have would be, provide a copy of the payroll report. And I would conduct what is known as a payroll reconciliation. I would tie the third-party payroll report from ADP or Gusto to this amount that is recorded in the financials. Why do I do this? I do this because if the payroll report shows something like 3 million, we need to locate where the other 600,000 is reported in expenses in the income statement. Because I would assume that these payroll expenses should tie directly, assuming everyone on the payroll report is being correctly expensed when incurred. There often are discrepancies in a payroll reconciliation when the company leverages 1099 employees, or the owners are taking payments outside of the payroll system. But for purposes of the income statement review, we're looking to flag it, write a question, and keep moving. So let's continue down the list. This one was flagged. It still falls under the green bucket, but things like job materials um, is an example of something I would want to learn more about because I would expect this to be included in operating or in direct costs rather than in operating expenses. So again, I would say describe the nature of this account, and um, it would be a flag for me when I do meet with the sellers and ownership company of the company uh, to quickly work through these accounts and extract as much information as possible. Um, right now, if you are on day 3 of an LOI and you haven't started a procedure like this, I would encourage you to work with your provider and do an income statement review uh, and understand, what are the nature of the revenues? What is the nature of the expenditures, the operating expenditures and the direct expenditures? Um, and what are those GL accounts comprised of? Conducting this assessment can take an hour, 2 hours at the most, and it sets the framework for a proper analysis. If you jump into things such as customers, etc., before doing this, you may miss some material items right away. So, I flagged another item called payroll expenses. So this GL account, I would have assumed was grouped together in the line item payroll up above. Based on how the report was generated, it looks like there's an additional account. So this is something I flagged, and I'm going to ask them a question. I assume this is payroll related, but we need to double check. So again, I would say describe the nature of the account, maybe an additional question. If we continue moving down the financials, nothing on a line by line basis has been flagged as excessive. Um, a few other things I would ask questions about are I would want to understand the rent. You'll see uh, the rent costs have fluctuated year over year. So I would very likely flag this, and I would ask them the questions, why is rent effectively zero? It used to be 35,000. Who owns the building? Is it owned by the ownership group or is it owned by a third party? So that's what I would write. I would say, you know, understand rent expense. Who owns building? Discuss lease, etc. Here's what I see in practice around rent, since we're on the topic. More often than not, a lot of these small business owners own the building the business is operates in a separate LLC outside of the business you're looking to purchase. Sometimes the real estate is included in the sale. More often than not, it's excluded. If the ownership group owns the building, what I've seen in practice is for for whatever reason, the business has decided to not pay rent in the year of sale. Um, and since the rent is discretionary because it's a related party activity, the owner owns the business and the real estate, they can do that. If they want to operate rent free, that's totally acceptable because both parties own the same asset. Uh, you as a new business buyer will not have that luxury. You will be paying rent, and it probably will be increased. So something like this is an easy way owners can reduce expenses and prop up earnings. This is just another facet to quickly understand what does that look like. Uh, Other questions I would ask around are I would ask about the miscellaneous. Miscellaneous is a broad category, which is often, it can be owner related, etc. So you just want to understand, like, they spent $15,000 and recorded to miscellaneous. What's in it? What's the nature of it? Is that something I would do as a new owner? You want to understand, like, what is it comprised of? Um, and then ticking through the rest, typically other expenses and other incomes should be, if they're categorized correctly, non-operating. But if you see things like ask my accountant, this is a default used in QuickBooks and other accounting systems. You want to just understand what is the nature of it, what's included in it, etc. Um, Additional items I would have questions around, which I always highlight, is discussing repairs, so building repairs, automobile repairs, understanding the nature of it. Frequently, things like automobile are very owner-centric, so I would flag this as perhaps possibly owner-related non-business expense. Um, You'll see here there are additional things around expenditures such as health insurance, liability insurance, and automobile insurance. Understanding if these are owner or personal in nature. So I would ask the question, describe the nature of this account. And you can modify this as needed, but if you want to copy and paste, at the very least, when you sit down and you have this, when you try to have a meaningful conversation with management, you can quickly navigate to some of the categories and have a conversation around it. Um, a few other items I always like to ask about are repairs and maintenance. So you'll see here, repairs and maintenance has 4 accounts. So some of these small businesses don't have the best GL reporting standards. So sometimes they'll just create new accounts when they're entering information. Uh, there's nothing malicious around it, but you need to understand what does like the total repairs look like. So I would flag these accounts and understand, what are the nature? Like, help me understand it. Um, and then I would, again, focus on some other larger items, such as, advertising and marketing. This fell under the bucket of a vertical analysis, but it's still 5% of total revenue. So has the business, it seems like it's been steady as a percentage of revenue year over year, but are there certain changes in how they're marketing to customers that is what are they doing is just the questions I would ask to extract information. Uh, so that's a typical line by line analysis of a small business. You'll see this source came directly from QuickBooks. So most small businesses operate under QuickBooks. Um, so a formula, and formatting from this data set is something you should be able to knock out and conduct. If you're not a CPA or financial expert, or if you don't come or comfortable with an analysis like this, I would encourage you to, rewatch this YouTube video and leverage maybe a third-party team. Uh, as a CPA and acquisition professional for the last decade, I've conducted this hundreds, if not 1,000 times. So conducting an analysis like this from the income statement level sets the stage for a fundamental understanding of what the business, how the business is performing, and more importantly, what are some of the drivers of this growth, or what are some of the drivers of this decline?